Hey everyone. This is another clip from my interview with Ali Moin Afshari. And before we get into the clip, I just want to share this chart from June 26th, 2025, which was just a few days ago. And the reason I want to share it is because as I was trading this day, I realized that it was unfolding in the exact same way as a similar chart that Ali's explaining in this clip I'm about to show. And I thought it was a really interesting and cool way to be able to learn the lessons from that clip, is to be able to extract the lessons and apply it to a day that just happened. And so if you study the destination or the target that Ali's talking about in the clip and the path to that destination, what to expect, where to place the orders, it all matches up perfectly in this chart. And I think it's the best way to learn those lessons is to look at this chart. Once you've watched the clip, come back to it and see all the ways that you could apply that knowledge. And last thing before we get into the clip is that tomorrow is July 1st. So it's the official launch day of the Trade With Me program. Super excited to announce that. I'm obviously going to post a reminder tomorrow and the full interview tomorrow. So make sure you check that out. And also make sure you check out the link in the description to sign up for TWM. So let's move to bar 20. How would you go through the flow chart for bar 20?
All right, so bar 20. Well, the first question is always in long or short. I think we are still always in long. Market's above the moving average. Moving average is steeply up. By the way, the color that you see on the moving average is another indicator that are programmed, and it measures the angle of the moving average and classifies the moving average into 5 different categories. Strong bull trend is light green. Weaker bull trend, like here, is dark green. Same colors, weak and a strong bear trend, dark red and orange. And then trading range when it is narrow and blue. So it has a 5 state classification for the moving average. And it's for easy decision making, especially as a training tool. So when you're looking here and making decisions always in long or short, if the moving average is steeply up and it is light green, market is always in long. Price is above, moving average is up, it's steeply up, so it's always in long.
Right.
Bar 20 is potentially a double bottom bull flag in a strong bull trend. And I already talked about why the market should go above 16 high. So although we have 4 bars down and 2 of them are strong, this is a legitimate double bottom bull flag. It's this second attempt down, first attempt down here, second attempt down there, and it's the first test of the moving average in about 20 bars. So there are a lot of things going on for bar 19, but 19 is a doji looking buy signal bar for the double bottom bull flag. So you need one more bar. So here's one more bar, bar 20. It's another breakout bar, very strong close, very strong bar. The only problem with it is the leg down might hesitate before it goes up because of the strength of the leg down. So okay to buy 20, stop is below 19 low. And the assumption is that we're going to have a hesitation before the market resumes. But the same CE is telling us new high of the day. So new high of the day after a pause. So if you are taking the trade, you shouldn't be disappointed by a pause. And this is one of those beginner situations when they take the good trade and there's a pause. They don't estimate the pause. They don't think the pause is going to happen, but it's going to happen. And then they close the trade immediately with a small loss, a few ticks maybe. And then they miss the trade.
Yeah, I think that those 2 layers are so important, that knowing that we're probably going to go above 16, so knowing that expectation and knowing that we're also probably going to hesitate, it gives you so much peace of mind in knowing what path the market is going to take to get to the target it's probably going to reach. And I think that level of understanding is why experts like yourself and Dr. Brooks say that you can stay calm when you're in a trade because you've already thought all these things through. You know what to expect. So when we look at 20, let's pull up the flow chart and go through this process. So we're always in long. We see the moving average is light green, still in a strong bull trend. Now we had a strong bear move down. It's a double bottom bull flag. would you classify us as now in a trading range, or are we still in a trend?
All right, so let's go back to the chart. As long as you're in this kind of an environment where two sides can trade and scalp, you're in a trading range.
Got it.
But the point that most traders forget is that the bull trend itself is built of periods of trend, trading range, trend, trading range. Every time there's a pullback, you're in a trading range. So the pullback, sometimes it's simple, like here, just one bar or a couple of bars. Sometimes it is more complex, like the rest of it, which is sort of like an expanding triangle. But it's a pullback. Every time the market is pulling back, it is in a trading range because you have a move against the prior move. And that's the minimum definition for a trading range. You have a leg up followed by a leg down. So market's in a trading range. But you also have to remember that trends are comprised of periods of breakouts and trading ranges. Look at this chart. All of the bars in this portion of the chart that are not going up are forming trading ranges. Some of them are dojis, 1 bar trading range. Some of them, like 24 inside bear bar, is a 2 bar trading range, 23 and 24. So depending on how the market shapes that trading range, trading ranges form inside of trends, but they are usually continuation patterns. So market eventually breaks out of the trading range and goes to a new high. So on 20, the expectation is we're going to hesitate and go higher, but we are still in a trading range with an expectation of a break above the old high of the day. That was the minimum expectation which happened here.
So for bar 20, if we look at the flow chart, how are we making our decision for our entry?
All right, so at this point, we are still always in long, but we are in a trading range portion of a trend. And trading range seems to be wide because it has legs with 4 bars in it. So it's bigger than 1 bar. So you have to trade in the direction of the always in, which means don't short, look for buys.
And so is that buy the close, or how are you going to buy that bar?
You're going to buy that bar knowing that the market's going to pause. But the expectation is that we're going to go above the high of the day. So the trade is still a long trade with an option to scale in lower. And if you look at the opposite side, bears probably sold above 18 high. And if you are in a trading range, that gap should close. So the limit order is to buy at the high of 18 when, bears who sold here and they see the breakout, they see the high 2 reversal. They know the trade was wrong. So they have to exit there. So you buy with them when they are buying to exit, you're buying to add to your position.
So when you're in a trading range, you may still buy the close if there's a target above, but then you also look for areas of support where bears might be trapped or just in the lower third, somewhere in the lower third. In this case, you're saying there's a 4 bar bear micro channel. Bears will sell the 18 high, and they'll get filled on bar 20, but then they get a small surprise against them.
Exactly.
So when they get a small surprise against them, now they're trying to exit break even, and you know that.
Yeah.
And so you're going to buy where they're exiting their shorts.
The other thing is you can actually skip the buy on bar 20 to buy lower with a limit order, but there's a cost to that trade. The cost is missing the opportunity. So if you don't want to miss the opportunity, buy a fraction size position or have enough, capital to add to your normal size trade, but scaling lower. If you're okay with losing the opportunity, which is fine, I do it all the time. I'm basically more than a breakout trader. I'm a pullback trader myself. But I understand the cost of the opportunity. The opportunity is that sometimes you get strong follow through and don't get your pullback. And by the time you get the pullback, it's already too late. So you have to have thought about it beforehand and be perfectly fine with missing roughly about 20% of opportunities. But the day has, 70 tradable bars. So you miss 1 or 2 trades, doesn't matter. There's something else set up 3 bars later. So
right, you find what you're comfortable with, knowing that there's going to be another trade, a better later trade.
Yeah.
I think this is interesting because I think something that I struggled with a lot is when I see 20 and we're in a trading range, my thought was always, oh, it's a trading range, so I shouldn't trade it. And what I learned from you is that it just means that you may not have as much urgency. You still want to trade in the always in direction, but you may look to buy lower, or you may look to buy and buy more lower. But it doesn't necessarily mean skip. You have to understand the whole context
Exactly.
for example, we're probably going to get to a new high of day
Yeah.
because it's a parabolic wedge, but it's in direction of the trend.
Correct.
So probably going to get trend resumption. So there's so many factors that go into it. And my decision making was mainly trading range skip, but that's not all that goes into it.
Yeah. There's usually more than that. And the more small things that you see, the easier that decision making becomes, but only after you can process all of that.
Right.